All right, everyone talks about credit. These are the three numbers that are important, matter more than credit, okay? Number one, debt to income ratio, that's the DTI, is what is your total monthly debt obligation, including the new mortgage, versus your income, okay? So as an example, if your income is $100,000 annually, okay, and you have $6,000 a month in expenses, including the new mortgage, your debt to income ratio sits at 60%. That's way too much. That's above the guideline requirements. Unless there's certain products that will allow it, but for the most part, no. Another item is what we call loan to value, LTV. What is the value of the house versus how much you're putting down? So if you're putting down 3%, then you've got a 97% loan to value. If you're putting down 5%, then you're at 95% loan to value. If you're putting down 20%, then 80% loan to value. So on and so on and so on. The idea behind that is, in some cases, how much you're putting down affects your credit, affects your buying ability, and also affects your monthly payment. So those are very important things to consider. The third thing to consider is your income. And beyond that, beyond your income is things that we don't see. Do you have child care? Do you have obligations, travel, baseball as an example, or anything like that we don't know about? You need to consider that in your monthly debt obligation. What you should do is what you're comfortable with. In other words, the mortgage payment plus everything else that you've got going on.